A massive purge at Berkshire Hathaway, the company ruthlessly slashed nearly 30% of its portfolio and completely liquidated its stakes in tech giants like Amazon and Visa. Let's look at Berkshire Hathaway's latest 13F filing. At first glance, most people expected management to continue with its usual slow and deliberate building process. The reality is something else, entirely. According to the latest data, Berkshire's portfolio has shrunk from 42 companies to just 29. This is not fine-tuning, this is a ruthless cleanup. The company sold a net total of $8.1 billion worth of shares during the period. Facing a $24 billion selling wave, there were only $16 billion worth of buy orders. In addition, they completely liquidated previous positions such as Amazon, Visa, MasterCard, and Domino's Pizza. But why is all this happening? Why is Berkshire dumping the giants of the tech and financial sectors? Many people think that Warren Buffett is the one behind the decisions, but there is a fact that few talk about. At Berkshire, Greg Abel and the investment team are increasingly taking control, and they are now fiercely reviewing the portfolio. And here comes the twist. While they are spectacularly dumping the markets, they are pouring money with both hands into a tech giant they had previously almost completely avoided. Berkshire purchased no less than 36.4 million shares of Alphabet Class A stock, increasing its existing position by more than 200%, while also entering into Alphabet Class C shares as a new position. Why now, of all times, when the industry is buzzing with massive capital expenditures due to artificial intelligence? Because Berkshire realized that Alphabet's revenues and cash-generating capability provide a rock-solid foundation despite the AI race. This is classic, deeply rooted value investing in a modern guise, buying premium quality at a rational price. But let's not get ahead of ourselves, because the report still holds some surprises. Alongside technology, Berkshire has also returned to an old, well-tested sector. They established a significant position in Delta Airlines and increased their stake in the New York Times as well. But there is a problem that we cannot ignore. While capital flows into Alphabet and airlines, Berkshire's cash pile continues to break astonishing new records, approaching $380 billion. What does this mean for the global economy? When the world's most experienced capital fund chooses to hold a significant portion of its wealth in cash rather than deploying it into today's overheated stock market, it sends an incredibly powerful signal. They are signaling that at current prices, it is extremely difficult to find a truly good deal. They are waiting it out. They are preparing for a potential market correction where cash will be their greatest weapon. The only question left is, if they are being this cautious, how worried should retail investors be about their portfolios?